Hello and welcome to Big Deal. Today we are going to focus on REITs as well as InvITs. Now this is a kind of an instrument for fundraising which was developed in the Indian markets only 3 years back, and we have seen several listings. And at uncertain times like this also there is a new issuance that we have seen from the House of Raheja's Mindspace Business Park is raising about 4,500 crore rupees through its REIT IPO. So has this instrument reached an inflection point in India? Will it come up as a matured asset destination for investors? And will more capital intensive companies really look out for this particular instrument for fundraising opportunities? To discuss this particular bit, I have with me two gentlemen who are well entrenched in this particular sector and have been working on it. Shah of IndiGrid, a listed InvIT, and Sundareswaran S of Morgan Stanley, the investment banker who advised on the Mindspace Business Park REIT IPO. Gentlemen, so good to have you on CNBC TV 18. Now, my first question on the big issuance right now. Sundar, you worked on this one. What is it that the investors are really betting on for a commercial real estate company and its assets? Because at a time when work from home is becoming more prominent and there is a huge amount of overhang on whether or not the office space is going to be in use at all in future.
I think what this product really does is this is a product which offers a fairly steady stream of cash flows with an inbuilt growth option, which is really the hallmark of this product. And that's true across both REITs and InvITs. Now, while what you said, there is some amount of uncertainty in the markets today around work from home, whether it could have an impact in terms of commercial real estate absorption. I think the general view which both occupiers, investors are sort of forming is this is a passing phase, and there are probably equal number of counterbalancing factors which are there. While there could be some amount of work from home and impact around that, the equal number of counterbalancing factors in terms of higher density per employee, limited new supply which comes in, more space requirements per employees, all those are sort of counterbalancing. And at the end of the day, I think office rentals as a part of a corporate's total expense, operating expense or fixed operating expense, this is still a very small component. So when people look at it, yes, I mean, I think people are still sort of trying to figure out what's the right time for people to sort of get back to the office. But from a longer term perspective, at least the view seems to be that, I mean, office space will continue to see reasonable amount of demand and traction. And from that perspective, what the product offers is really a diversified mix of office spaces with a diversified mix of high quality tenants, AAA corporate tenants, a lot of it are global corporates and high rated Indian corporates as well. And the fundamental thing is, as is with most real estate asset classes in the country, there's a strong inbuilt growth trajectory when it comes to the rentals, which sort of supports and aids that. So there's an ongoing yield which investors can expect out of that. And on top of that, there's an expected growth which the product.
Right. Harsha, you have been a listed entity now for a while. How do you see the sector's growth in terms of giving returns to the investors across the board? And do you think it has reached an inflection point where more companies will use this particular instrument, more investors will see this as a dominant asset class also going forward?
I think from our perspective, we have been listed for about 3 years now. And we have delivered about 44% of total returns to investors since listing, which majority of that includes our distribution and the small price appreciation. I would say that in general, even beyond unlisted InvITs, the performance has been great. And I think the underlying fact for that is that InvITs and REITs are required to hold a very safe portfolio, which includes largely operating assets, and have mandatory payout ratios, which reduces the volatility as well as provides stable returns. And I think that's something which is panning out over the last 3 years. To your next question on inflection point, we certainly believe that 2020 is an inflection point for InvITs and REITs for several counts. One, it's the first time we have finished a 3-year track record. Second, over last year or so, we have seen 6 or 8 more InvITs and REITs coming and listing. They can be privately listed, but they're listed. And across commercial real estate, transmission, road, gas pipelines, and telecom towers in the last. So we have seen that varied range of sectors getting owned by InvITs and REITs, and substantial amount of global knowledgeable capital flow going into these assets. And this, to be honest, over the last 3 years, I would say we have attracted about 1,15,000 crores of assets under management between the listed InvITs and REITs put together, which I would say is one of the big success for SEBI and Ministry of Finance, that since the time the first InvIT got launched in 2017, in the first 3 years, you have 115,000 lakhs crores of assets under InvITs and REITs, which is a big thing. And now we are seeing a long pipeline of new businesses coming up, including governments-owned entities like NHAI and Power Grid. So we believe that this is going to become a way of owning infrastructure assets in India, which provides liquidity, governance, and a little bit of tax efficiency. So I think certainly we would see a lot more of this coming in the coming future. And the regulations have over the last 3 years evolved. So we feel it is certainly a inflection point because of matured regulation, continued investor support and confidence, and existing investors and assets being already listed as a track record. So I would say it's certainly an inflection point.
Right. Right. So Sundar, you just had an interface with so many global investors for this large offering from the House of Rajas. Now, what is it that the investors feel in terms of the REIT InvIT structures in India and the tax efficiency, as well as the kind of returns that they are gaining? The ones who did not make it to this particular IPO, or the ones who are sitting at the fence, what is it that they want more for it to become a much more pronounced instrument to be used by the Indian companies?
So I think the first thing I would sort of highlight is real estate as an asset class is something which is getting a lot of interest from global investors. So if you look at most of the long-term capital providers globally, most of their allocation to real estate as an asset class has consistently been on the rise. I mean, call it early part of last decade, it was probably in mid-single digits. The stated intent for most large capital providers is to at least get it to sort of a mid-teen sort of a level. And that's a pretty substantial jump in terms of their allocation towards real estate as an asset class. And I know this, I mean, we're talking about both REITs and
Right. So Sundar, I think your line is quite scratchy. We are not getting a great network to hear you properly. So let's do one thing. Let's slip into a short breather on Big Deal, and let's reconnect you so that we can hear all your comments on this particular question. So stay tuned. Welcome back. You're watching Big Deal, and we were discussing the scope of REITs as well as InvITs and what more needs to be done so that it can be used as an instrument effectively by the capital-intensive companies as well as the investors. So Sundar from Morgan Stanley, he was talking about what is it that the investors want more from this particular instrument for them to be much more attracted towards India's offering. Sundar.
Yeah, I mean, I think what I was saying was, I think in terms of what investors are expecting, I don't think really people are sort of expecting more from the product itself. I think if you look at the regulations, I think the regulator has done a fantastic work here to get the best of the global regulations. While the regulations are largely modeled on the Singapore regulations, it imbibes best practices from most other jurisdictions. And we have a regulation which is sort of I would say undoubtedly one of the best globally. And that has given a lot of comfort to some of the high-quality investors who have consistently been investing in the REITs. So I think from a regulatory perspective, we probably tick all the boxes one could expect here. What makes the product attractive for the Indian market is, one, obviously, the characteristics of the product itself. It offers a stable yield. But one aspect where the Indian markets are probably pretty unique is the growth that the asset class offers. The contracted escalations for most commercial real estate assets are in the region of 4.5% to 5% per annum, or 15% every third year. And that is a pretty significant contractual escalation of growth in rentals and growth in yields, which people can expect from this product, which meaningfully adds to the total returns an investor can expect. And this is where India starts differentiating from most other global economies, because the growth rate in most other global economies would be significantly lower. So when you have a best-in-class regulatory framework, when you have investors who are constantly looking to increase their allocation to real estate as an asset class globally, and you have a product which offers a healthy going-in yield with an ability for appreciation or growth in rentals, that makes it a pretty interesting and a viable proposition, which is why we have seen a pretty reasonably strong response to the recently completed REIT IPO, and we expect there should be more.
Right. Now, because of the reasons of work from home because of the pandemic, and also the force majeure clause, which can be used in the real estate space for the lease agreements, and looking at the pure comparison between the already listed REIT projections that have been given by Embassy now, Sundar, looking at the projections, the growth projections that have been put out by Mindspace, it is rather lower in terms of the rival comparison. So do you think there has been a discount built in because of the uncertainty to really make it more attractive for the investors?
Yeah, I mean, I wouldn't say, there is a discount built in or anything. I think whenever a REIT sort of goes to the market, people sort of price in the expectations of growth or the expectations of the market thereafter, which is what has happened in the earlier REIT as well as this REIT. In the case of Mindspace REIT, the initial draft of the document was filed in late December. Since then, post the impact of pandemic, there have been revisions to the projections, which was also sort of put out. So the projections take into account in a reasonable manner the expectations in the new environment. But as I sort of stated earlier, the general view seems to be that, this is a phase which shall pass. There could be some near-term impact, but given the real estate as a percentage of the total operating cost for most occupiers is a pretty small amount, the demand for this asset class, in our view, would continue to remain robust.
All right, so demand will remain robust, but Harsh, coming to you, one particular instance from the finance bill, one particular aspect which really rattled the investors as far as the taxability in REITs and InvITs is concerned, had really cast a shadow on this as an instrument, a workable instrument. Of course, there has been some sort of a relaxation that if you do not comply with the new corporate tax regime, which is lower in rate, then the dividend tax will not be applicable in the hands of the investors. How do you think this has panned out, and is it still impacting the investors? Harsh? Harsh, can you hear me?
Hi, Deepika. I think I'm on live and there is a break happening.
Right. So you can go ahead with the tax aspect, Harsh, that we were discussing about the dividend distribution tax and its application on REITs as well as InvITs. Now, despite the clarification coming in from the Finance Ministry, how is it panning out now? Is it a spot of bother?
Okay, so I think it impacts different InvITs and REITs differently, because the clarification from the Ministry of Finance came in two manners. One, if the subsidiaries of InvITs and REITs are following the new tax regime, in that regards, the eventual dividend would remain taxable in the hands of investors. And if they are following the old tax regime, then it will remain a pass-through. So I think what has been done is the impact has been neutralized for InvITs which are following the old tax regime, and InvITs which are following the new tax regime would have a particular impact on that front. However, most of the InvITs that we know are focused on providing distributions in form of interest, and therefore it's taxable in the hands of investors depending on their own tax bracket. And therefore they are not materially or rather impacted at all. However, REITs who are dependent only on dividends as a method of distribution and plan to follow a new tax regime may get impacted. However, from Mindtree prospectus that I read, I believe most of their dividend is coming from SPV under the old tax regime, and therefore probably that will not have a material impact.
Right. And Sundar, let me come to you on the debt securities, the debt instrument part of REITs as well as InvITs, and the ability of long-term and depth, the investment classes with depth to invest in them. There is a bottleneck there. Do we require more regulatory relaxations on that particular front?
Yeah, I mean, I think on that front, today there are restrictions in terms of who can participate or invest in the debt securities of a REIT. If there are enabling provisions for foreign portfolio investors and banks to invest in debt securities of REIT, we think that will go a long way. As you would have noticed, I mean, there has been a pretty strong response from foreign portfolio investors towards the equity side. And based on our discussions which we are having, the interest even to sort of play in the debt side of the capital structure is pretty strong. So this is something which had been announced in the previous budget. And as and when the operational framework for those are sort of put in place, I mean, we do think that will help further evolve the debt capital structure or the debt security market for REITs and InvITs.
All right, so this is the regulatory aspect, but Harsh, let me come to you for the final question. What will make REITs and InvITs as well traded and robust as the equity market, and what are those few important transitions that need to be made in this particular instrument in its 2.0 stage?
Yeah. So when I said, Nisha, 2020 can be an inflection year for InvITs and REITs. There are two things which is stopping InvITs and REITs to achieve its true potential in India, like it is across the world. One, that, and both these recommendations or issues are not to do with relaxations, are just to do with level playing field. One, InvITs and REITs are trading at a lot size, which makes it about 1 lakh rupees of lot size in terms of trading, which has an impact on liquidity for both retail investors as well as institutional investors. And I believe if they are trading at par with equity, which is single unit, like a single share, we will see a lot more liquidity happening, a lot more domestic capital getting tapped in to own Indian assets. Eventually, InvITs and REITs are made to have good platforms for Indian investors to own Indian assets. While global investors would chip in and start with a large size of capital on day one, we need to be able to channelize Indian capital to own Indian assets. For that, what is essential is to let them allow to trade like a normal equity, which is a single unit. So I think that's one big change which should be considered. SEBI has reduced it in the past from 5 lakh to 1 lakh, and we have seen a substantial change in terms of liquidity and volumes. We believe if it is brought down to 1,
right,
we'll see a lot more going forward.
Yes.
The second change which Sundar touched upon and you touched
All
upon.
right. Yes. Yes. So many suggestions coming in from both Harsh as well as Sundar to make REITs as well as InvITs as a more robust entity for fundraising as well as an investment destination for many global investors, especially at a time when the financial sector may be grappling with its own asset issues. The capital intensive sectors like real estate as well as infrastructure can really look at other options of fundraising requirements. With that, it's a wrap on Big Deal. Thanks so much, Harsh as well as Sundar, for joining in, and thanks to all our viewers for tuning in.